We are taught from day one to follow a very specific set of rules. Get a reliable 9-to-5 job, keep your expenses as low as humanly possible, and put whatever cash is left over into a bank account. The expectation is that if you do this long enough, decade after decade, you will eventually build a large enough cushion to retire comfortably. Yet millions of people follow this exact playbook without making a single mistake, only to reach their 50s and realize their net worth has barely moved. They are working harder than ever, but their upward financial mobility is frozen. This chart shows exactly why this happens. The flat, low trajectory line shows the actual growth of standard savings over time, while the sharply accelerating curve represents the rising cost of living, aggressively overtaking it. Traditional financial advice ignores this gap. Parking your money in a traditional bank account is not a safe haven. Because of how these two trend lines interact, hoarding cash can actually anchor you to the middle class. To understand why this trap is so effective, we have to look closely at the underlying mechanics of a standard wage. Salaried labor is a linear income stream. For every hour of time you give to an employer, you receive a fixed unit of capital in return. It is a rigid one-to-one exchange. But there are only 24 hours in a day. Because your time is finite, your income hits a physical limit. No matter how much effort or skill you apply, you cannot work more hours than exist, meaning your earning potential is capped. While your income is pinned against that ceiling, inflation begins working in the background. It silently reduces the purchasing power of the static cash you have already accumulated. When we convert those eroding savings into a long-term performance chart, the problem is clear. The flat line represents the minuscule yield of a standard savings account, while the steeply rising curve tracks standard market indices, leaving it behind. Stretch these mechanics over 20 or 30 years, and the damage compounds. The combination of a capped income, eroding purchasing power, and near-zero yields creates a massive wealth deficit. These factors create a mathematical ceiling where saving alone cannot outpace the combined drag of inflation and capped income. To move past this, you have to change how you view asset allocation. People who build sustainable wealth do not focus on hoarding cash. Instead, they direct their capital into high-leverage vehicles designed to scale. They look for asymmetric opportunities. In an asymmetric bet, you risk a tiny known amount of capital or effort for the chance at massive, outsized returns. The potential upside vastly outweighs the downside risk. These specific wealth accelerators require strategic effort to build, separating them from the often misunderstood concept of effortless passive income. The primary engine is equity-based growth. This means owning a stake in a scaling enterprise. As the business grows in value, your wealth increases independently of your hourly labor. The second engine is intellectual property. You create an asset, a piece of software, a patent, or a media property, exactly once, and it can generate revenue indefinitely. It provides leverage on your initial time investment. Equity and IP break the rules of the 9-to-5 wage. They sever the restrictive link between the hours you work and the money you earn. Modern wealth building is detached from the simple metric of how much of a paycheck you can set aside. It is about redirecting your most valuable resource, your time. Instead of trading those hours for a linear wage, you have to allocate them towards acquiring and building scalable assets. This requires a deliberate change in perspective. You have to willingly move away from a low-yield model and accept the friction required to build something you own. Your targets are clear: acquire asymmetric equity and develop intellectual property. Long-term financial mobility is no longer achieved by following the savings blueprint, but is exclusively reserved for those who leverage the asymmetric ownership blueprint.